Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking markets. We spent a lot of time this week focusing on commodity moves. Now it's time to focus a little bit more on the markets that were recently, especially the S&P, just at all-time highs, but are showing a little bit of weakness again to end the month. Almost a trend we've seen over the last 4 to 5 months where a little bit of weakness comes in. It has been pretty quickly bought, but the interesting thing about this month is early on next month, we have the election. So who knows if that's playing a role in all this. We are chatting with Joel Elconin, co-host of the Benzinga PreMarket Prep Show and editor of the PreMarket Prep website. Joel, as I just broke down there, market weakness to end this week, and it looks like to end this month. What's your takeaway from this? How concerned are you?
Oh boy, oh boy. You guys kept me like at a time when there's a lot of things going on in the market and I don't like to be like too short-sighted and make a big emphasis on the immediate price action, but today's price action is horrible. Absolutely horrible for us to be, on the S&P being in the green by 50 points and we're going red. I just think that we can tie it into whatever we want. Interest rates not going down or the uncertainty over the election. But I just think that I think people are taking their chips off the table. There's no reason to be entering new long positions at this juncture. And there's a lot of reasons to be exiting, or taking some chips off the table. So I guess that there's uncertain. There's one thing the market doesn't like, and that's uncertainty. And I think we're entering a very uncertain period.
Well, Joel, just to that point, we've had a lot of people come on our show over the last week or two and say they were going to be pulling in their horns, taking off positions in front of whatever happens post election. There's a lot of people that have been talking about that in the financial markets too. And then we've seen things like gold getting a bid and the big tech stocks coming back in vogue. Is that because of this uncertainty where people are either taking the safety trade or just saying, hey, I'll just go to the sidelines?
Couple factors in that. I mean, you had the big unwind of the carry trade with the yen. Now the yen is really coming off, so maybe that trade has been revisited. Also, rates. I mean, if you look at what the bond market's telling you, the bond market's telling you the rates are not going to go down as much as people expect. And you know what? That your big tech companies are not as dependent on financing and rates as the small caps and a lot of the other companies. So I think there's just a combination of that. Hey, the Fed, has been benign. They did that half point cut prematurely, in my opinion. And I don't think they're going to be doing anything after election. So it's just a couple. Tech stocks seem to win no matter what. It rises interest rates or falling interest rates. So there's your safety in the market. You never thought you'd be saying that. The safety trade's the tech trade.
Yeah, wild, isn't it? But hey, these companies are sitting on boatloads of cash. So I guess it comes back to that old concept cash is king, especially in higher interest rate environments. But is that all that this is right now, Joel? Is a safety trade simply before the election? And then when the election happens, markets could potentially rotate money into whatever sector might be favored depending on whoever the winner is?
No, I just no, I think that the market is so focused on rates going lower. Earnings season, of course, earnings, the fundamentals seem to matter too. But I think what people are just, I think there's just overall uncertainty, and there's definite different geopolitical things that are going on, different things that you're hearing. You don't know what's true and what's not true. But if you look at the U.S. stat, if you look at the geopolitical situation, if you look at maybe the prospect that rates are not going down, then what more could you say for potential sell signals?
Well, are there any areas of the market that you really are seeing besides tech maybe that you're saying, "Hey, I still see some opportunity here to get long even though it's a little dicey market right now?"
Put. I'm just joking. No, I mean, the gold market, if you're talking about, the safety trade, gold here. People, I know your listeners are very happy about the recent move in gold. So the gold stocks don't always move as much as the bullion does, but gold seems to be catching the bid. I'm looking at, stop. I can't believe I'm saying this, but it's giving it back today. I mean, GM had a good report, but that hit 54. It's giving it back. Tesla's back in favor. So, man, autos, I just don't know about that. I mean, Ford certainly hasn't responded. Energy, it's just so volatile with what's going on with the Middle East. I mean, you look at some of these stocks and, with the volatility in oil, yeah, sure, ExxonMobil hit a new all-time high, but that pulled back off its all-time high. The healthcare sector, I mean, you have your winners and your losers, but you have companies like Eli Lilly. They've just had unprecedented, returns over the last couple years. Competition coming for it. I don't know, but man, I mean, tech and gold and the other move here, which is absolutely flabbergasting here, is the utilities. They continue to hold up here near all-time highs. And what you have is value dividends, and now you got a story with the AI. And you can be a believer in you want, but I mean, the standard deviation move in these utilities is just, mind-boggling. But if you're a strict trend follower, buy high and have it go higher. That's where the money's been going to, contrary to what the TLT and the bonds have been doing.
Okay, so hey, there are still some bright lights out there, Joel. There are some sectors to be in. What about earnings recaps? We're still early on in the earnings season for Q3. Anything stand out to you? Any forecasts that you're noting? What should we take away from this quarter's earnings season?
I mean, I think overall it hasn't been too bad. Early on, you had J.P. Morgan. Oh boy, that's consolidating up here. It seems like if you do good, you're being rewarded. The pops don't always hold, but if you do bad, you're getting punished, and you don't really get much of a chance to get back. But I think people are we at the peak of our earnings cycle? Are valuations too high? Well, you could have said that 6 months ago when the market continued higher. So you haven't got your Apples yet, Nvidia's later. You haven't had some of your tech big guns report yet. But it's like, if it's good, they catch a bid with you, and if it's bad, they pound you into oblivion.
Well, Joel, just to that point about valuations, when we talked a couple of years ago, remember 2021, the adage was valuations don't matter till they matter. And then in 2022, they almost got overcooked to the downside. It seems like maybe it's a more rational market now where they're actually looking at valuations. Do they matter, or does it just matter if you hit or miss the guidance?
They don't matter till they matter. And I'll just give you an example of a stock like Celsius Holding, right? Just a tremendous growth play. And then the first whiff that you got of that stock of slowing growth, it's been absolutely punished. So as long as you can keep producing, the growth and showing the, exponential growth, then you're fine. But at the first hint, or when something comes out of the CEO's mouth that says, hey, we're not growing as fast, then they turn and they turn and they turn fast. So it doesn't matter until it matters. But right now you are getting to the point with certain stocks that, are they going to be like a stock like Cabo Holdings, just making a new all-time high today? And that's just based on them opening up hundreds and hundreds of restaurants. So when you start saying, hey, we're not opening as many, or we're closing some, or we're seeing, year over year declines, then you have to head for the hills. But a very, I guess just call it a fickle market.
That's a good term for it, and that, I guess, kind of ties into a recent call by Goldman, a macro outlook, the decade out, 10 years. We all know how good the last 10 years has been for markets. Goldman is saying, look out for the next 10 years. It's not going to be that good. Joel, have we heard Goldman make a call like this before, and what's your takeaway from a call like this?
I mean, I think they're being realistic here. And, they're just, if you look at the returns, that you've had in the market over the past decade, to see that continue under the current, geopolitical and economic environment, I'm kind of siding with Goldman here. They see the S&P returning 3% returning 3% over the next 10 years. So that 3% per year. I mean, for a guy like me, boom, boom, boom. I mean, been looking to grow my portfolio, from 7 to 10, over the years, and the bad years, try not to get hit as much. So, I mean, that it is under what, the expected return of the market is, but look how much we've exceeded the expectations, the overall return in the market. So I'm not going to argue with Goldman here on this one.
Joel, for people that are maybe more short-term trading oriented, you look at technicals, you give people positions to get in and out on your pre-market prep show. So not for people that are buying and holding, for the long term, which generally will trend higher. Would you tell short-term traders to maybe hedge their bets here a little bit, or maybe get out of the way of the upcoming volatility? Or is it a period where you're going to be looking to pounce on particular deals if there's some volatility that you can capitalize on?
I always like to focus on, if you're talking to people about, trading or, positioning, to me, the closing prices are really what matters, right? And the mark. And what I look at, for the S&Ps here is, you made your all-time closing high. When was it? It was over 5,900. You made that back on October 14th, right? And you had to close near that area. Now, this week, 5,900 has been defended, and today's high, 5900.75, which is almost not quite the high for the week. So, for a battleground here, I would, unless the S&P can break above 5,900, stay above it, establish, not just a couple days, but establish a sustained bid above 5,900, then your Tom Lee and all your other mega bulls looking for, 6,000, 6,100, I'd be in their camp. On the other hand, I would look at this week's low at just above 5,800. This is basis the futures. So breaks below 5,800, I think things get a little dicey on the downside, at least to the lower 5,700s. But I think for traders, investors, long, short term, look for highs, and then some kind of consolidation period, and then the move out of the consolidation period. The S&P basically, after making that all-time high, it lulled you to sleep for 2, 4, 6, 8, almost 10 sessions before you had that crack on Wednesday. So after you see extreme moves, wait for the consolidation and then see how the stock moves out of that consolidation area. And right now, baby, we're trading, the S&P futures are trading 58.56. That's smack dab in the middle between 5,800 and 5,900.
All right, Joel. We'll wrap it up here. Not much more to say on these markets. You're more than a little concerned moving into this election, moving into next week. We'll see where the markets open, but I think one thing is for sure, we're going to see a lot of choppiness and volatility before and even after this election. Who knows if the markets will keep giving these almost generational returns that we've seen, but boy, oh boy, it has been a great prior decade for investors simply in the broad averages. Joel, thank you as always for your time. Everyone, click that link in the show notes to visit Joel's website, PreMarket Prep. Have a great weekend, Joel.
Okay, thank you, guys.